In this video, I'm going to give you 4 dividend investing hacks in under 3 minutes, so let's jump into it. When buying a dividend stock, be sure to check its 10-year yield, so you can easily see if it's higher or lower. Ideally, you want it to be decreasing over time so that it shows that the stock has had better capital growth than dividend growth. However, if it has been increasing quite rapidly over the last 10 years, this could be an indicator of a falling share price and therefore is a red flag. You should know that the dividend yield will increase in times of large sell-offs, such as recent recessions. So seeing a dividend yield spike up during, for instance, the dot-com bubble of 1990 to 2000, that area, and the financial crisis, the recent recession in about 2008 to 2009, you'll see dividend yield spike up. That's fine. But what you want to see is the fact that it's still a number, but rather than just cutting or suspending their dividend. Checking the dividend payout ratio is the quickest way to see if a company has a healthy balance sheet without checking the balance sheet. Typically, you want it to be less than 70%. 70% is quite high. Any higher than that is quite risky. You want them to have room to grow the dividends, but you also want them to have spare money to reinvest into the company as well. Typically, you want it to be around 50 to 60%. Ideally, with payout ratios, it's like a high health bar. The lower it is, the better. So if you've got a company with a payout ratio of 20%, it means they've got loads of money to reinvest into the company. Loads of room to grow their dividend in the future. The exception of REITs is due to taxes, and in fact REITs will give you the highest possible payment they can available. If you've enjoyed the video so far, please consider subscribing for monthly stock picks to watch or to buy, and weekly portfolio updates. Now this one's a bit of an oddball, but it is to sign up for an email subscription with Dividend Max. And you may think, I don't want updates. Hold on for a sec, right? Because you can subscribe to each of your stocks that you have in your portfolio. You go onto the website and you type in all of the ticker symbols of the companies you own or you're watching. And then each time they announce a new dividend, it will be sent to you as an email. There's no spam. It's just one email telling you that they've now done this for their dividend. And it will tell you if it's been cut or suspended also. So it's a great useful tool for dividend users. The price to earnings ratio allows you to see the amount of premium people are willing to pay for a company. It's worth comparing it to other companies in your sector. So for example, if one company has a ×5 but the other has a ×23, the people with the ×23 or the company has a higher premium that people are paying for it. It's worth comparing your individual companies to the sectors. So how does the industry perform? If the industry has an average of ×20, it means it's quite a premium. However, ×5 means that it's very undervalued compared to the rest of the industry. So it's worth keeping that in mind too. So thank you for watching. I'm Osborne Foreman. Have a great night.